Hello! Today we will be covering the LIFO, or last in first out method for calculating cost of goods sold and ending inventory. On the right, I have a list of transactions that the company was involved in, including purchases and sales. On the left, I have a chart where I will show my work as we complete this problem. There are three columns I will be filling out. First, we have purchases, which we'll use only when the company purchases new inventory. I have a plus sign here because new purchases add to our inventory. The next column is COGS, or cost of goods sold, and we will use this column anytime the company sells some of its inventory. I have a minus sign here because sales subtract from our inventory. The third column is inventory, which is where we will keep track of how much inventory the company has as of a given date. We need to add to the inventory column anytime there is a purchase, and subtract from the inventory column anytime there is a sale. Our first piece of information is from January 1st. The company had 500 units of inventory, which they had previously purchased at $10 each. Since these units are part of beginning inventory, we can place them in the inventory column. Now, some instructors will have you calculate the inventory balance at this stage, taking 500 times $10. But in this video, I'm going to wait until the end to do any calculations. Next, on January 2nd, the company purchased 300 units at $11 per unit. Since this is the purchase, we can add it to the purchase column. Since there were no sales on this date, we can skip the cost of goods sold column. Now, we always need to fill out the inventory column. On January 1st, we had 500 units at $10 each. And since there were no sales, those units are still in inventory. So we copy them down for January 2nd. Additionally, 300 units were purchased at $11 per unit. And since purchases are plus, that means that they add to our inventory. In order to make the rest of the problem easier, I'm going to highlight our chart based on inventory cost. So let's make the $10 per unit inventory yellow. And let's make the $11 per unit inventory green. Next, on January 7th, we have our first sale of 640 units. So that means we get to use our cost of goods sold column. Now, before we record this transaction, I want to make something clear, and that's the difference between cost and selling price. As we can see in the units sold at retail column, the company sells its inventory for $35 per unit, so the selling price is $35. Looking at the units purchased at cost column, we can see that the company pays anywhere from $10 to $15 per unit for their inventory, at least for the month of January. Now, the cost of goods sold column needs a cost, not a selling price, so we can't put 640 units at $35 per unit here, since $35 is the selling price and not the cost. But if the cost ranges from $10 to $15, which cost should we put in the cost of goods sold column? Well, that's where the different inventory costing methods come in. And this video is about the method called LIFO, or last in, first out. So what we do is we look at our inventory in layers. In this case, we have the yellow layer, that's $10 per unit, and we also have the green layer, which is $11 per unit. And we need to grab the units that were there last, in this case the green units from the January 2nd purchase. Since the green units were the last ones in, now they will be the first ones out, or sold. That's what it means to apply LIFO, or last in, first out. But that doesn't quite cover the 640 units sold. So we need to go to the next layer, the yellow units, and grab the remaining required units. The question is, how many units do we still need? Well, we had 640 units that were sold in total, minus the 300 green units that we already recorded, equals 340 yellow units sold. Now, one thing to remember is that the total of all units in cost of goods sold for one particular date must add up to the total number of units sold on that date. So in this case, 300 plus 340 equals the 640 total sold. So we're good to go. Now we need to calculate the January 7th inventory. Since cost of goods sold is a minus, That means we need to take our previous inventory and subtract anything we sold, one layer at a time. So that's 500 yellow units at $10 each minus 340 yellow units sold, which equals 160 yellow units remaining. As for the green units, we can take the 300 in our previous inventory and subtract the 300 sold to get 0 units remaining. Since there are none left, there's no need to list them in the inventory column. On January 11th, the company sold 120 more units. Since we made a sale, we will be using the cost of goods sold column again. Now, this one's a bit easier than the last one, since there's only one layer of inventory to choose from, the yellow units. So we grab 120 units and put them in the cost of goods sold column. Now for our inventory column, remember, cost of goods sold is a minus, so we must take the previous inventory and subtract any sales we made. So we take the 160 units in inventory minus the 120 sold to get 40 yellow units remaining. Next, on January 19th, we have a purchase of 400 units at $13 each. Since we have a purchase, we can record these units in the purchase column. Now we need a new color for the 13 per unit inventory, so let's use orange. Moving on to the inventory column, on January 11th, we had 40 units at $10 each. And since there were no sales, those units are still in inventory, so we can copy them down for January 19th. Additionally, 400 units were purchased at $13 per unit, and since purchases add to inventory, we're going to add that amount to our inventory column. Next, on January 21st, we have a purchase of 110 units at $15 per unit. Since we have a purchase, we can record these units in the purchase column. Now we need a new color for the $15 per unit inventory. So let's use blue. Moving on to the inventory column, on January 19th, which is the previous date, we had 2 layers of inventory, yellow and orange. And since there were no sales, those units are still in inventory, so we can copy them both down for January 21st. Additionally, we had the 110 units that were purchased at $15 per unit, and since purchases add to inventory, we can put that in our inventory column. Finally, on January 23rd, we have a sale of 510 units, which means we get to use the cost of goods sold column again. Remember, since we're using last in first out, we need to start with the inventory that was there last, in this case, the blue units. Now we can move on to the next oldest units, which in this case would be the orange units, going from bottom to top. And this problem actually worked out quite nicely because the blue and the orange layers of inventory we just copied into the cost of goods sold column happened to add up to exactly 510 units, which is the number of units that were sold on January 23rd. So we don't need to break into any of the yellow units. Now we need to calculate the January 23rd inventory. Since cost of goods sold is minus, meaning it subtracts from inventory, we must take our previous inventory and subtract anything we sold, one layer at a time. So first the yellow units at $10 each. Since those don't show up in our cost of goods sold column, we can list them in the January 23rd inventory. Next, for the orange units, we had 400, but all of them were sold on January 23rd, so there's no need to list them in the inventory column. The same can be said of the $15 blue units. These units were also all sold. So that leaves us with just the 40 units at $10 per unit in ending inventory. Alright, we have done the hard part. All that's left is to calculate the cost of goods sold and the ending inventory. To calculate the cost of goods sold, we simply multiply the units and the cost for each row of the cost of goods sold column and add them together. So that's 300 times 11 plus 340 times 10 plus 120 times 10 plus 110 times 15 plus 400 times 13 equals $14,750 for cost of goods sold. Thankfully for inventory, all we need to do is calculate the balance as of the final date, which is January 23rd. So that's 40 times 10 equals $400. So technically we are done. We got the cost of goods sold to be $14,750 and the ending inventory is $400. But there's one more step we can take to check our work. We can calculate something called the cost of goods available for sale, which is simply the beginning inventory plus all purchases. So that's 500 times 10 plus 300 times 11 plus 400 times 13 plus 110 times 15 equals $15,150. Now, if we take the ending inventory of $400 and add that to the cost of goods sold of $14,750, we get, well, $15,150, which is the same as the cost of goods available for sale. So that's a good way for you to check your work, and it works regardless of which inventory costing method you are using.